If you are receiving Social Security benefits right now, or if you plan to claim them in the next few years, I need you to stop everything you are doing and watch this video from beginning to end. Because what is happening with Social Security in 2026 is unlike anything we have seen in the past decade. And the people who are going to be hurt the most are the ones who never got the warning. I'm going to be completely honest with you. Some of what I'm about to share is going to make you angry. Some of it is going to surprise you. And some of it, if you act on it today, could protect thousands of dollars that would otherwise quietly disappear from your retirement. There are 5 urgent warnings every Social Security recipient needs to know right now, plus 1 bonus warning at the end that most financial advisors are not even discussing yet. I have broken this down as clearly and simply as possible, because this information is too important to be buried in government documents that nobody reads. Warning number 4 is the one catching the most seniors completely off guard in 2026. Make sure you stay for that one. Let's get into it. Before we get into the warnings, let me give you some context about why 2026 is such a critical year for Social Security recipients. Social Security was signed into law in 1935. For 90 years, it has been the financial foundation of retirement for tens of millions of Americans. Today, approximately 71 million people receive some form of Social Security benefit every single month. But here's what most people don't understand about how the system actually works. Social Security is not a savings account. The money you paid in over your working years does not sit in a vault with your name on it. It goes directly into a trust fund, and the money coming out today is being paid by the workers paying in today. This matters because the Social Security trustees, the people who manage these funds, publish a report every single year showing the financial health of the system. And the 2026 Trustees Report contains information that every single recipient needs to understand. On top of that, there have been policy changes, administrative changes, and enforcement changes in 2026 that are directly affecting benefits right now, not in the future. Now, if you find this information valuable, please subscribe and hit the notification bell. Every single week, this channel releases information specifically designed to protect American seniors from financial surprises. All right, warning number 1. Warning number 1, the 2033 timeline that every senior needs to understand. The Social Security trustees have been issuing the same warning for years. And most Americans have no idea it exists. Here is the warning in plain language. The Social Security Trust Fund, the reserve that helps pay benefits when payroll tax revenue falls short, is projected to be depleted by approximately 2033. Some recent estimates put it even closer, 2032. Now, before you panic, let me be very precise about what this means and what it does not mean. It does not mean Social Security disappears in 2033. Social Security will still receive payroll tax revenue from working Americans. That revenue alone would cover approximately 79 to 83% of scheduled benefits. What it does mean, if Congress takes no action before that date, benefits could be automatically cut by approximately 17 to 21% for every recipient. For a senior currently receiving $2,000 per month, that is a cut of $340 to $420 every single month, permanently. Now, Congress has addressed Social Security funding challenges before. In 1983, they passed major reforms that extended the program's solvency. Most analysts expect some form of congressional action before 2033. But here is the critical point. Most seniors are making retirement income decisions today. Decisions about when to claim, how much to spend, what to save, without factoring in any possibility of benefit reduction. What should you do? Step 1. Do not build a retirement plan that assumes your current Social Security benefit is guaranteed at its current amount indefinitely. Step 2. If you have not yet claimed, Consider how the timing of your claim interacts with this timeline. Step 3. Make sure you have other income sources that could partially absorb a benefit reduction without catastrophic impact on your lifestyle. Step 4. Contact your congressional representatives. Constituent pressure is one of the most powerful tools for pushing legislators to act on this issue. This is not a reason to panic. It is a reason to plan. That is warning number 1. Let's move to warning number 2. Warning number 2. The cost of living adjustment problem. Every year, Social Security recipients receive what is called a COLA, a cost of living adjustment. This is designed to help benefits keep pace with inflation. In 2026, the COLA adjustment was 2.5%. On the surface, that sounds reasonable. A 2.5% raise. Your benefits went up. But here is the problem that nobody is talking about. The COLA is calculated using something called CPIW, the Consumer Price Index for urban wage earners and clerical workers. This index tracks the spending patterns of working-age Americans. The problem? Seniors spend their money very differently than working-age Americans. Working-age Americans spend a significant portion of their income on housing, transportation, and entertainment. Seniors spend a significantly higher proportion on healthcare and prescription medications. And here is the critical data point. Healthcare costs in the United States have been rising at rates consistently higher than general inflation. In many years, healthcare costs have increased 2 to 3 times faster than the overall inflation rate. This means that the COLA, calculated on working-age spending patterns, consistently underestimates the actual inflation that seniors experience. The result? Every year, even with a COLA increase, many seniors are falling further behind. Their benefits go up 2.5%. Their actual cost of living goes up 4, 5, or 6%. The gap widens. Silently. There is actually a proposed alternative index called CPIE, specifically designed to track senior spending patterns. Studies show it would have resulted in higher COLA adjustments in most years, but it has not been adopted. What can you do about this? You cannot change how COLA is calculated, but you can plan for it. Assume that your Social Security benefit will not fully keep pace with your actual cost of living, especially your healthcare costs. Build that assumption into your retirement budget. Plan for your out-of-pocket expenses to grow faster than your benefit grows. And if you are not yet on Medicare, get on it as soon as you qualify. Medicare coverage, despite its own cost increases, provides significant protection against the healthcare inflation that erodes senior purchasing power. That is warning number 2. Warning number 3. The 2026 earnings limit trap. This warning is specifically for seniors who are under full retirement age and still working while collecting Social Security benefits. In 2026, the Social Security earnings limit is $22,320 per year for people who have not yet reached full retirement age. Here is what that means in practice. If you earn more than $22,320, Social Security will withhold $1 from your benefits for every $2 you earn above that limit. I want to give you a very specific example so this is completely clear. Say you are 63 years old. You are collecting $1,500 per month in Social Security. That is $18,000 per year. And you are working part-time, earning $30,000 per year. You are $7,680 over the earnings limit. Social Security will withhold $3,840 from your benefits. Now, many seniors discover this not through a letter warning them in advance, but through a notice saying they have already been overpaid and need to return money. This is because Social Security pays benefits throughout the year, but only reconciles earnings after your tax return is filed. By the time they discover you exceeded the limit, you may have already received months of benefits you were not entitled to. The good news, There is an exception for the year you reach full retirement age. In the months of that year before you reach full retirement age, the limit increases significantly to $59,520. And starting the month you reach full retirement age, the earnings limit disappears entirely. What should you do right now? If you are under full retirement age and working, calculate your projected annual earnings today. If you are approaching $22,320, call Social Security immediately and ask them to adjust your monthly benefit proactively. This prevents an overpayment situation entirely. Do not wait for Social Security to discover it. Contact them first. That is warning number 3. Warning number 4 is coming up. And this is the one that is hitting seniors the hardest in 2026. Warning number 4. The 2026 Social Security overpayment crisis. This one is urgent. I mean that sincerely, because what is happening right now in 2026 is causing real financial hardship for seniors across America, and most of them had no idea it was coming. The Social Security Administration has significantly increased its overpayment recovery efforts in 2026. Seniors who were overpaid, sometimes years ago, are now receiving notices demanding repayment, sometimes for amounts of $10,000, $20,000, or more. And here is what makes this so devastating. In many cases, the overpayment was not the senior's fault. It was an administrative error by Social Security itself. A reporting delay, a system error, a communication breakdown between agencies. But once Social Security determines there was an overpayment, they want the money back. And if you don't respond, they will begin recovering it by reducing your monthly benefit. Sometimes by withholding your entire monthly check until the balance is repaid. Imagine waking up one month and your Social Security check, the check you depend on for rent, food, and medication, is simply not there. Because Social Security is recovering an overpayment you didn't even know about. This is happening to real seniors right now. Here is what you must know. Write 1. You have 60 days from the date on the overpayment notice to file an appeal, not 60 days from when you received it. 60 days from the date printed on the letter. Write 2. You can request a waiver of repayment if you can demonstrate that the overpayment was not your fault and that repaying it would cause financial hardship. File Form SSA 632. Write 3. You can appeal the overpayment determination itself if you believe the amount is wrong. File Form SSA 561. Write 4. While your appeal or waiver is pending, Social Security cannot begin recovering the overpayment. Filing the appeal buys you time. Write 5. You can request that Social Security reduce the recovery rate. Instead of withholding your entire check, they may agree to withhold a smaller percentage. What you must do if you receive an overpayment notice. Step 1. Do not ignore it. Do not put it in a drawer. The 60-day clock starts immediately. Step 2. Read the notice carefully. Understand exactly what they are claiming and why. Step 3. If you believe it is an error, call Social Security at 1-800-77-21213 and request a full explanation. Step 4. File either Form SSA 561 to appeal or Form SSA 632 to request a waiver, or both. Step 5. Keep copies of everything, every letter, every form, every call. Write down the date, time, and name of the representative. This is not a situation where patience is a virtue. You must act immediately. That is warning number 4. Warning number 5. More of your Social Security is being taxed than ever before. This warning has been quietly hurting seniors for over 40 years, and it is getting worse every single year. Here is the background. In 1983, Congress established income thresholds to determine how much of your Social Security benefit is subject to federal income tax. The thresholds are these. If your combined income, which is your adjusted gross income plus any tax-exempt interest plus half your Social Security benefits, exceeds $25,000 as a single filer, up to 50% of your benefits may be taxable. If it exceeds $34,000, up to 85% of your benefits may be taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000. Now here's the problem that has been growing silently for 40 years. Those thresholds have never been adjusted for inflation. Not once. Since 1983. In 1983, $25,000 was a very comfortable income. In 2026, $25,000 barely covers basic living expenses in most American cities. What this means is that every year, as Social Security benefits increase with COLA adjustments, more and more seniors are pushed over these thresholds. Not because they are wealthier, simply because inflation has made $25,000 worth less and less. Today, an estimated 56% of Social Security recipients pay federal income tax on their benefits. In 1984, it was only 10%. That is the silent tax increase that nobody voted for and nobody announced. What can you do? Strategy 1. Manage your other income sources carefully. Keep your combined income below the taxable thresholds where possible. Strategy 2. Consider Roth IRA conversions. Withdrawals from a Roth IRA do not count toward your combined income for Social Security taxation purposes. Converting traditional IRA funds to Roth, even partially, can reduce the percentage of your Social Security that is taxed. Strategy 3. Be strategic about when you take IRA withdrawals. Bunching withdrawals in certain years, or spreading them across years, can help you manage your combined income. Strategy 4. Work with a tax professional who specializes in retirement income. The strategies available here are significant, but they require careful planning specific to your situation. That is warning number 5. Before we wrap up, I promised you a bonus warning, and this one is critically important. Social Security scams targeting seniors have reached record levels in 2026. Here's how the scam works. You receive a phone call. The caller claims to be from the Social Security Administration. They tell you your Social Security number has been suspended due to suspicious activity, or that you owe money, or that your benefits are about to be cut off. They create urgency and fear. And then they ask you to verify your Social Security number, your bank account information, or to make a payment, sometimes in gift cards or wire transfer. Here's what you must know. The Social Security Administration will never call you and ask for your Social Security number over the phone. They already have it. The SSA will never threaten to suspend your benefits over the phone. The SSA will never ask you to pay anything by gift card or wire transfer. If you receive a call like this, hang up immediately. Do not engage. Do not press buttons. Do not try to argue with the caller. Then report it to the Social Security Administration's Office of Inspector General at 1-800-269-0271 or oig.ssa.gov. In 2025, Americans lost over $2.6 billion to government impersonation scams. Seniors were the primary target. Do not become a statistic. That is the bonus warning. Let's recap everything we covered today. Warning 1. The 2033 Trust Fund Timeline. Plan for potential benefit reductions. Do not assume your current benefit is guaranteed forever. Warning 2. The COLA problem. Your benefits are not keeping pace with your actual cost of living, especially healthcare. Plan for the gap. Warning 3. The earnings limit trap. If you are under full retirement age and working, know the $22,320 limit. Contact Social Security proactively. Warning 4. The overpayment crisis. If you receive a notice, you have 60 days and you have rights. File your appeal immediately. Do not ignore it. Warning 5, the silent tax increase. 56% of recipients now pay tax on their benefits. Manage your combined income strategically. Bonus warning, phone scams. The SSA will never call you asking for your number or demanding payment. Hang up. If this video helped you, please share it with a senior you care about. This information could protect their retirement. Like this video and subscribe to Senior Money Secrets. Every single week, we release warnings and strategies specifically designed to protect American seniors. The next video is already on your screen. Watch it now. It covers 5 taxes that seniors are legally exempt from, and most Americans have no idea. I will see you there.